The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good Monday morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN just after 9 a.m. Eastern Time. We got about 24 minutes to go until the start of trading. Quite the week last week to the upside. We finished the week, quite an acceleration, right? You zoom in on the action, man. You see the run. These are 1-minute bars, folks. I just wanted to pull it up. Boy, it was a heck of a finish to the markets. You were trading at 41.25 with 7 minutes to go. The markets accelerate to highs of the week. You close it out at about 41.40, almost at that price level. You did get to a high of 41.41. Right as we came into the close, and this morning, pretty tame action, all things considered. Not in the oil market, though. We'll get over that. A surprise cut from OPEC Plus boosts the price of oil. That's going to complicate inflation a little bit, at least on the headline issue. Core is what the Fed's been focusing on so much, but nonetheless, crude right near $80 this morning. We get the S&Ps negative by 4. You get the NASDAQ 100 negative by 81. We get the Dow right now. You see the resurgence, right? A little bit of volatility. You get the Dow right now up by 104 points. You got the Russell up by 5, battling a little bit of a cold this morning. I got a couple kids in the house. They're battling a little bit of a cold, whatever it is. Almost getting over it. But nonetheless, I'm a little bit stuffed up, but feeling okay. We'll make it through the hour. We got crude, as I mentioned, right at $80 to the penny as we speak. Let's go back to a 5-minute chart here, at least, to make things a little bit more readable. We got the price of crude. Spikes to $81.69 last night on the surprise news of an OPEC Plus cut. $81.69 the high. We're just chopping around $80 for the price of crude. Gold contract. Look at that move, man. Right? You talk about some action overnight. Pretty tame markets, and boy, we got some action in gold, man. Last night, down to almost 1965, and boom, just like that, we're right near 2,000 yet again on the gold contract. Silver with some volatility as well. Silver off 10 pennies right now at 24.05. We jumped to notes and bonds. Pretty tame action considering where we've been recently. You got the 10-year negative by 2 ticks at 114.27. Let's take a look. What are we talking about for yields right now in the 10-year? We're talking about 3.5% right on the dot on the 10-year. The 30-year down about 5 ticks at 131 on the dot. We jump over to the VIX. Talk about volatility getting sucked out of this market, man. Come on, catch up. VIX 1955. Now, usually when you see this type of action, folks, okay, that you see quite a spike on the VIX, right? Last week was a one-way trip to lower volatility prices, 1852. Waiting to see on the open what the theme of this week may bring to us. Shortened week. I know our man Dan in the Den was talking about, it sneaks up on you, folks. Markets closed on Friday for Good Friday. Easter sneaks up. How quickly? Easter Sunday coming up. Yeah, so markets closed on Friday. We got a 4-day work week. Gotta love it. And you have the VIX with a pretty dramatic spike, all things considered. When you get the market pretty flat, we're down by 4 points. Yeah, you've clawed back some of the losses, but pay attention, man, because sometimes when you see that VIX spike and you see the market not reacting yet, pay attention to the fact that that is S&P volatility premium. People are paying premium to protect themselves. Maybe crude spooking a little bit of the market this morning because that's going to weigh on things, to put it lightly. Excuse me. To put it lightly, indeed. All right, and let's jump over. Might as well start it off with the crude price, right? There it is. OPEC Plus makes shock million barrel cut in new inflation risk. Saudi leads cartel with its own 500,000 supply reduction. Yeah, the White House not a fan. You know, and I was thinking about it, because politics are going to start coming into it, man. We're coming into 2024. It's going to be quite a show in New York tomorrow with President Trump getting arraigned. And it would make sense that the Saudis would not want to make life easy for Biden, man. But what you think about politics, okay? My estimation would be that they want President Trump in there. They want him on the orb, okay? They want to be touching the orb. They all want to be touching the orb, right? To some degree. So not too surprising, and you're going to see this play out, man. There's going to be a lot of pressure over the next whatever it is months as politics come in, and you're seeing the beginning of it right now. And yeah, you better believe, man, that we saw crude at $64, okay? A lot of the headline numbers in inflation recently to back up crude, folks, we're talking about almost a year of lower crude prices. In any other universe, this would have been crushing to inflation, okay? Because most of the times in recent past, when we've had inflation flare up, most of the times it's been driven by headline inflation where crude has had a dramatic impact. Now, when we saw crude to spike to 123 last June, let's even back it up a little bit more, to get the two spikes in there, okay? You spike originally on the war in March, that's a year ago. You make it back up to above 120 in June. Since then, it's been a friend. Okay, we have had lower crude prices for almost the better part of a year. Excuse me as I battle this cough, man. We'll make it through the hour. I'm going to have to mute myself a few occasions as I battle that cough. Point being, you see the spike. We're right back up to basically the area that's been a little bit of resistance in the price of crude. $82, $83 has been the top end of that crude price. And boom, we spiked there originally. We're up to $81.69 overnight. Risk reward wise though, at $64, right? What was the possibility that we go to 80 or we go to 50? Boy, folks, I think we are in for potentially some higher crude prices, and that is going to make things very difficult at a time when the Fed is fighting inflation anyway. They're dealing with some really hard and sticky inflation in the services sector. And if you start seeing crude prices spike, we are coming into summer, okay? You got crude at $80 and you got OPEC plus cutting. Yeah, they're not fools, folks. They know what's happening. They want higher prices down the line. And they realize what is going on in terms of the inflation battle going on across the globe, let alone in the U.S., and how that's going to make things more difficult. And yeah, not by chance that gets done, and crude just spikes right to the upper boundary. And if you break above this area, right, $90 is the next stop right away, and you break above $90, man, it's like 110, 120. It could be. Things move that quickly in this market, man. Would be remarkable, and I don't know how the market's going to handle if we have inflation raging, and then you start getting the headline numbers, inflation raging again. Okay, because in all the talk about inflation, and we're going to jump to some of the services number because they're pretty stark in terms of the services and how sticky the services number is, and still is right now, even on the heels of a pretty decent PCE number on Friday, right? Less than the market was thinking. A cooler number for inflation than the market was thinking on Friday for PCE. But boy, pay attention to this crude chart, man, because that's the writing on the wall, folks, okay? OPEC Plus, they're not comfortable with crude between $65 and $75. They want higher prices, man. They surprise the market. Keep that on your radar, folks, because that's not going to make life easy, man. What's going to happen if we start seeing the services start to tame? And then what happens? Maybe we see the headline start coming back up because we got energy prices rising yet again. It's just round and round we go, man. The pockets of this economy in terms of where inflation is, how sticky it is. In some areas it's not. In some areas it is. And that's the battle that the Fed is facing right now. And yeah, what's going to happen? Now you have a banking crisis that's sprinkled on top of inflation. And now you have energy prices spiking yet again from a surprise OPEC cut. Very difficult to imagine where we go from here, folks, but we're going to get to find out, man, as we kick off April trading. April 3rd, we got Easter coming down the line in 6 days, man. We got a 4-day work week. Lots to talk about this morning, folks. We got a lot of equities moving, a lot of fundamental news to talk about. Don't go away. We'll be right back. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years years' experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
TFNN has launched the Tiger's Den, hosted at Discord. TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Welcome back, folks. We get the S&P's negative by 4 points right now. Let's put it on hourly, going back about 20 days, and take off some of these Fibonacci numbers just because we've thrown through there. Well, you know what? I'm not going to take them off just yet, because check this out, folks. First, we'll go back for a daily. A couple points to put on your chart. Interesting here, 41.79, folks, okay? You challenged this February high. Maybe that's where the market pushes things to. Interesting, that is the 1 to 1.618 expansion. So you go from a price point of about 40.60, maybe. You could cherry pick the high there. I'm just kind of taking an area that I found to be the top of that March 6th acceleration that the market really began lower. You come down to a price point about 38.50, and 1 to 1.618 expansion will bring it right basically back to those February highs, and maybe that's where you test it. In terms of maybe potentially a market rolling over. I see a lot of risks in this market, man. It doesn't mean they're going to play out right now. This may take 3 or 6 months to play out. But you look at what the market's thinking about for rates. Look at what the market's thinking about for inflation. And then you see the news this morning that guess what? We're going to be paying higher prices at the pump coming into summer, man. And this whole idea that inflation is just going to go away quicker than we thought because of the banking crisis, it just doesn't make sense to me at all on a fundamental basis. So we put that on there. That's an area that you want to put on your chart, folks. You get up to 41.80 or so in this market. Risk-reward-wise, I like the action to the downside in this market, as I've been talking about, right? And boy, last week, that wasn't the case at all. And we'll see how this week goes. We start things off in pretty tame territory. We get the opening bell in about 10 minutes. We get the VIX elevated in a slight degree, but you take out all that volatility that we got during the banking crisis, and you're right back to 1955. But it is interesting that we're up about 85 pennies in the VIX right now. That's a 4.5% pop. And meanwhile, the S&Ps are barely unchanged, off 4 points this morning. Okay, so we talked about oil. What are we going to talk about? Let's talk about the S&P 500 and some of what's been driving this market, largely thanks to tech. I talked about this on some of my program last week, man. You take a look at some of these equities, right? How about Apple to kick things off? This thing is on a one-way trip, man. Apple, negative this morning. You get the NASDAQ 100, negative a bit this morning. And you're talking about a run for Apple, though, now I did this number on Friday before I believe I did it on Friday, before the huge acceleration that Apple had on Friday. But you're talking about Apple now trading from 164 to 164 from about 124. They just added $40 to the price of their shares, folks. And that is a gain of about 32% on the year. These tech stocks are just driving everything, man. You jump over to Microsoft shares, all right? Now we're going to take a look at the charts in a moment in terms of what tech is doing versus the rest of the economy. Even if you take when Microsoft kicked off the year, not cherry picking the low of 220, they kicked it off at about 240. What are we talking about? 48 bucks off about 240? Yeah, about 20% pop right on the dot is where Microsoft is up this year. These are some of the biggest companies out there, man. Google, little bit of a different story in terms of their acceleration. You go from about 90 to 104, but you can still see well above where the market is. These tech companies carrying everything right now. And we jump over to the article from the Journal. S&P 500's resilience in the banking crisis, largely thanks to tech. So this doesn't zoom in on just the year. It zooms in on where we've been since March 8th, okay? S&P 500, it's up about 3% since then when the trouble began brewing. I mean, just think about that, right? I joke with friends. It's like, you know what this market needed? All it needed, it just needed a banking crisis to get everybody bullish, man. And that's kind of what's going on. So use your head. Yeah, it could play out, right? Things could play out like that. This could tighten the economy. It could do the Fed's work for them. Or it could not, okay? That's the other part of this. Or it could not. Yeah, they talk about Microsoft. They talk about Apple, right? In fact, Microsoft and Apple together contributed more points to the benchmark's advance in March than all the financial stocks in the index subtracted. So just these two equities added more points to the upside than all the financial stocks added to the downside. Doesn't mean that we're over the hump yet, folks, okay? Now, it's a weighted index by market cap, which is how every index should be. Okay, the 5 biggest companies account for roughly 23% of the S&P 500. How about that one, right? So they have the greater influence over its direction, as it should be. Okay, they're the biggest companies out there, man. It should not be like the Dow where it's price weighted, which makes no sense whatsoever. I always make the comparison, folks. If you're a teacher in like freshman econ. Freshman, whatever it is, okay? Talking about high school. Freshman finance. They don't teach freshman finance. They should. They should teach more finance in high school overall. And somebody said to you, create an index model to represent some sector, some index of companies. And you came back with a price-weighted index that was price-weighted. Meanwhile, the price of an equity had no bearing on the actual value of that company. I think I'd ask the student what the heck they're thinking. Meanwhile, that's what the Dow does. Okay, to fast forward though, let's get to the chart I wanted to take a look at, which was this one right here. Try to zoom in. And this is talking about the winners and the losers. Communication services, information technology sector, both up dramatically. And this is talking about, excuse me, from March 8th. Okay, this is just from March 8th to March 31st. As you can see, and then you got the S&P up about 2.9%. If you go to the equal weight S&P 500, actually down 1.1% if you somehow equally weighted each S&P 500 company. And if you look at the financial sector, down 8% almost for that period of time, the final 3 weeks. So, you know, the tech companies, it's not bubblicious to the degree that it was in 2000 or 2008 or anything like that, okay? And that's what they do touch on here, okay? Even after last year's tumble, tech stocks still appear expensive when compared with the broader market. S&P tech sector, 24.4 times projected earnings over the next 12 months. The broader index, almost about 18. Pretty lofty numbers still with what we're dealing with, okay? Moreover, the total weighting of the tech stocks in the index is still at higher levels than the dot-com bubble. Yeah, but what they point out here, and I think rightfully so, is this is not a dot-com era crash, okay? These companies, Apple, Microsoft, Google's got a little bit of an asterisk next to it because of what's going on in ChatGPT. We'll go over that in a moment. But I would agree. And who is this? Mark Giambroni, portfolio manager at Barrow Hanley, pointed to the health of the tech companies' balance sheets, their innovation and ability to generate profits in the future. Neither is he nervous about a repeat of the 2008 financial crisis because the banks that have been hurt by liquidity issues rather than loan losses. Well, I'd say it's both, man. They have loan losses, okay, that they need to materialize because they need to be liquid. I was listening to one gentleman on Bloomberg early this morning, and he was making a comment about Silicon Valley Bank saying, you know, all the losses, $15 billion, were on the hold to maturity securities. And you only get to hold them if you can actually be liquid enough to not have to tap those securities. And that's not what happened, man. Okay. So it's kind of a merge between the two, but it is not 2008. It's not the bubble. But pay attention to how those tech stocks are doing, because you're pushing levels now. Okay. Weekly net flows into tech equities, mutual and exchange traded funds. How about that one, man? This is talking about week by week, folks. And look at the week, $1 billion into tech as they push it higher. What happens if tech begins to wane? Don't think it's going to collapse like, a market collapse, but they're carrying everything right now, the tech companies. And with that in mind, we got the tech companies pulling back a little bit. I mean, we just traded from 11,000 to 13,200. We got a bull market going on in the NASDAQ 100, folks. Stay tuned. We got a lot more to talk about. We'll talk some McDonald's when we get back. Stay tuned. We'll be back for the opening bell.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no cash or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern, for free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got markets open. You got an S&P down about 4 points right now. Boy, the theme last week, especially later part of the week, could not find a seller in this market. Going back 15 minutes, right? We make a low of 39.80 on Tuesday, and you finish up about 3% from where we were at those lows. We'll call it 41.20 or so. 41.40 really is about where you finished, man. Remarkable, right? 160 points in the S&P. That's about 4%, man. No, yeah. I had to recalibrate my brain there. Yes, that is 160 points which is about 4% off of the lows, and we're chopping around that level right now. NASDAQ 100, you're getting a little bit of selling action. You're off by 100 points. That's 0.75%. You got the Dow up by 0.3%, and the Russell positive by 6. We jump over to McDonald's. McDonald's corporate offices. Everyone's working from home Monday, Tuesday, and Wednesday of this week, and they probably get off Friday for Good Friday as well. Not a bad deal if you don't get fired in the next few days, as McDonald's temporarily shuts U.S. offices as the chain prepares for layoff notices. Pretty interesting how this takes shape, right? Fast food company expects to notify workers of their job status virtually. So they're saying, you know what, folks, everybody stay home. We're going to tell you who gets fired and who doesn't in the next few days, and then we'll invite everybody back that is welcomed back on Thursday. Temporarily closing its U.S. offices this week as it prepares to inform corporate employees about layoffs undertaken by the burger giant as part of a broader company restructuring. So they sent out an internal email last week. They should work from home Monday through Wednesday so it can deliver staffing decisions virtually. They asked employees to cancel all in-person meetings with vendors and other outside parties at its headquarters. During the week of April 3rd, we will communicate key decisions related to roles and staffing levels across the organization. And they declined to comment Sunday on the number of employees being laid off. So you'll see some headlines rip on this one in the next few days, I imagine. They said in January that it planned to make, quote-unquote, difficult decisions about changes to its corporate staffing levels by April. Well, today's first trading day of April, folks. The CEO said he expects to save money as part of the workforce assessment, but said that he did not have a set dollar amount. McDonald's has 150,000 people globally in corporate roles and its own restaurants. 70% of them located outside of the U.S. is where they are. And McDonald's in the message acknowledged that the week of April 3rd would be a busy one for personal travel, which it said contributed to the decision to deliver the news remotely. Personal travel, Easter, Good Friday, etc. Excuse me, and McDonald's, man, this stock, right? So you're higher by about 0.3%. You catch a lift this morning. This has been like quite a stock, man. You put this thing back on a weekly, this is a one-way trip. Now, that's a weekly, okay? Don't pay attention to this one, though. That's erroneous. That's why I want to pull it up. That's a daily. But you were just back there in September, October of 2022. This thing accelerates to a high of 281.67. And where did we just hit this morning, folks? 281.17. I think you got there in the pre-market. 281.50. So what did I just say that high was? 281.67? Yeah, within 17 pennies of the high right now. We'll see how McDonald's reacts, as this market can't hold this market down right now, folks. I say it in jest almost. My dad's texting me, it's so true, folks. I talk to my friends and just acquaintances. And what's changed since Chairman Powell went in front of Congress and said, inflation's sticking me, man, we're going to have to go higher for longer? The only thing that's changed is we have a market that potentially has banking strain. At a minimum, there is strain on the banking sector. That's at a minimum. If it was so easy to tame inflation that that's all we needed, then why hasn't it happened yet? We'll see how that plays out, to say the least. This is a good segue. Home prices, they're rising again. There's just pockets everywhere, folks. And we haven't even gotten to the services sector where things are sticky, okay? But what do we got? We got home prices rising. Prices nationally rose 0.16% in February, basically flat, okay? But we're not even going down. Now, seasonally adjusted, adjustments can cause some discrepancies in how those numbers play out. In December and January, mortgage rates began pulling back and home prices surged again. Home prices nationally, 0.16% in February. Strongest one-month gain since May of last year. Home prices are now 2.6% below their peak last June. Of the 50 largest U.S. markets, 39 saw home prices rise in February. That's a quick turnaround from November when prices were falling in 48 of 50 markets. Absolutely remarkable what's happening with housing right now. Excuse me. When you consider the impact that rates are having on demand, especially by residential consumers that cannot put the cash up. They are only able to buy what their signature is worth. And yeah, you've seen things dip a bit. But folks, we're still at pretty lofty levels compared to where our brains are kind of comfortable at in terms of, I don't see mortgages being comfortable at 6.5%. Meanwhile, supply and demand are dictating the prices of going up. So keep that on your mind. As with real estate, however, the price dynamics differ depending on location. Miami continues to see the largest price gains, along with more affordable markets in the Midwest, like Cincinnati, Columbus, Cleveland. Meanwhile, prices are still falling in some of the markets which saw the greatest price inflation over the last several years. Austin, Las Vegas, Salt Lake City, Seattle, San Francisco. Yeah. You want to make sure you have the wind at your back, folks. While some prices increase, most notably in Miami, which saw the largest of the month, can be chalked up to people moving to the area. We're seeing stronger price gains more generally in those areas with better affordability and larger inventory deficits. Florida's in a unique spot, man. And that goes across the board. Miami gets all the love. Tampa ain't far behind Miami, man. And some of the charts up there, you put it on a 3-year basis. I think I saw something like Tampa, 59%, something like that. So you see a dip of 2% from where we were at the highs. Meanwhile, you have some areas in Florida, folks, talking about almost a 60% price appreciation over a period of 3 years. So remarkable to see where that goes, to say the least. And look at this market, man. Can't hold it down. We catch a bid on the open right now. Let's see how gold trading up about $5. We jump over to the dollar index this morning. You get the dollar index. Come on, catch up for me. Look at this move, right? No, that's yes. Chart's a little bit slow. But you talk about some moves, man, and that's going to do it in gold. You knew the dollar was going to be moving, folks. When you see gold like that, dollar catches a bid to 103, and just like that, you're back at 102.34. Mammoth moves across the board, and we got crude sitting above $80 at 80.08. And I imagine the VIX is dropping a bit. No, holding up. We got a little bit more volatility. You do drop a bit as we get a bid on the open, but we're still at 19.50, and you were at 18.50 as of the close of Friday. Not often do you get a bid in terms of a whole point to the upside in the S&P. Meanwhile, we're positive, right? S&P is up 3 points, and you just saw the S&P, the VIX go up a full point. Pay attention. People are paying for premium. They wouldn't be paying for premium if they weren't a little worried. Why are they more worried today than they were on Friday? We're pushing those levels. We will find out. All right, where do we jump to next? Let's see if we can find it. I got a lot of stories to talk about here. Well, let's talk about a couple of these. Tesla. So their deliveries are out. Deliveries rose about 4% from the fourth quarter after discounts. Production exceeding deliveries will keep the debate going. Production exceeding deliveries, right? So inventory out there. We jump over to Tesla shares this morning. Tesla. Ooh, watch out. Production exceeding deliveries. Not what the market wanted to see, I guess. Down 3% so far this morning, up to 208 in the overnight, down to 201, down about 3%. We got a lot more to talk about, folks. Stay tuned. We'll be right back after the break.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Are you looking for a way to consistently add winning trades to your portfolio? Tom O'Brien is here to help. Tom O'Brien has been successfully trading markets for over 30 years. A frequent contributor to TD Ameritrade Network and CNBC, Tom O'Brien founded TFNN over 20 years ago to help educate investors just like you. Tom's daily market newsletter, Market Insights, is published every morning when the market's open to give you the competitive informational edge you need to succeed. These newsletters are packed full of Tom's advanced technical analysis and are geared to deliver comprehensive strategies for a successful portfolio. Get Tom O'Brien's newsletter, Market Insights, today and try all of our products and newsletters 30 days risk-free with our money-back guarantee at TFNN.com. TFNN, educating investors.
Will the S&P 500 continue to climb? For bold trades on U.S. large cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. S&P's up about 3 right now. How about the Dow up 210 right now? Dow, yeah, surging 33,667. Back to the 10-year real quick. Taking a look at the moves. Now, I'm going to take a look at where we've been basically for the first quarter because we're coming into a new quarter, okay? Oh, I might get a cough here. Hold on. Excuse me, folks. Let me grab a little drink here. Whew. Family's battling a little cold. Pretty remarkable when you just zoom in. There's a daily chart. We back it up to the beginning of the year. You come into the year at about 112 on the 10-year in terms of price. You trade up to almost 116. You trade down to almost 110. You trade back up to basically 117. And we're back to 114. So when you look at where we were January 1st and then where we are April 1st, okay, you don't get the full complex picture of how big the swings were during that time. But even just cherry picking where we were January 1st and where we were April 1st, the change has been dramatic. And that doesn't even include how things go array during that time. Where are we going to be in the next quarter, right? Very difficult to imagine. Now, we jump to the article I was talking about from Bloomberg here. Now, this is an opinion piece, okay, but they got some interesting facts in here. This is talking about from John Authors, damage done by the banking crisis looks overpriced. Central banks evidently believe they can contain the trouble without interfering with their goals on rates and inflation. That's quite a jump, okay? I imagine Chairman Powell's a little worried that it's going to make his job a little bit more difficult. And I'm putting that lightly with the word little a couple times in there purposely. I wouldn't be so quick to jump that he thinks it's going to be that easy. Now, here's the chart. I mean, we've seen it, folks, and this is why I did that comparison here to talk about where the Fed curve was for implied rate cuts December 31st versus where it was on March 31st, because things changed a lot, and the market caught up to the Fed, then it changed with the Fed. December 31st is in black, okay? December 31st. Now, remember here, December 31st, things were still out of whack in terms of what the Fed was saying and what the market was implying, okay? You can see that the market was implying even back on December 31st that we were going to peak out at about June, okay? Now, here's the difference. December 31st, the market thought we were going to peak in June, okay? Now the market thinks we're going to peak in May. But even back on December 31st, we were already pricing in 1 cut by September and 2 or 3 cuts by January, okay? Now, the market caught up to that. The market changed that, The market changed that to say, you know what, we're not going to get those cuts. And that's where you saw things really get out of whack in terms of you saw quite a pullback from the February highs, okay? As the market caught up to the fact that, hold on, you had Chairman Powell coming in front of Congress March 7th saying higher for longer, okay? The market recalibrated their bets. Now, I would like to see this chart with, show me like a weekly change in the curve. I mean, there'd be too many lines on that chart to make sense of it, but nonetheless, you get the point, okay? But look where we are now. Very difficult to believe this is going to be how things play out. Now, yes, we could peak, okay? We could peak in May. But are we going to get all these cuts? Are we going to get all these cuts? Are we going to peak in May at about 5%? Excuse me. Yeah, May. And then we're going to be at almost 4% by January. I don't see that happening, folks, okay? And we've seen how quickly the market can come around to change the expectations for where we're going to go in rate cuts. We've talked to our man, Kevin Hincks. We talk to him every Tuesday, Wednesday, Thursday, so we'll talk to him tomorrow. And he's agreed that it'd be very difficult to imagine. It can always happen, folks. He's used the term maybe an event. An event could take place. I find it very, 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 very difficult to imagine that we're going to get all those cuts by the time we're talking about January, that somehow, talking about futures, the implied federal funds rate is going to be back to 4.17%, which is basically means you're going to have a range of 4 to 4.25. Excuse me. Very difficult to imagine that happening. So then you go next step. If that's your opinion in the market, because that's my opinion, it's not fact. We get to see how it plays out. If that's my opinion, what do I think is going to happen if we don't get that type of play out in the market? What happens as we approach the next 3, 6, 9 months? Now, keep in mind, folks, that doesn't mean we have to keep rising. That doesn't mean we have to keep raising rates. All it means is we can't cut by 3. Are we going to get 3? This is pricing in 3.5 cuts. Okay, because we hit 5, 4.96. And you're talking about 4.17 by the January 31st, man. I don't see it happening, folks, okay? And keep that in mind, because what happens if that continues to play out, and what does the market do when we recalibrate? Look at this market. It just keeps going, man. It's not stopping. 41.79, folks. You back it up to where we were in December, 41.80. You back it up to the consolidation in February, about there. You back it up to the 1 to 1.618 expansion, 41.79. Put it on your chart. I think I'll probably get a short in there in the market. Doesn't mean it's going to play out. Doesn't mean it's going to be profitable, folks. But I like that area in this market if we get up to there. The other thing I've sent out to subscribers is be patient, okay? Be patient in this market. There's going to be plenty of volatility coming down the line. This yield curve I just showed you, that's going to take 9 months to play out. As in, that's talking about 9 months from now. There's going to be extreme volatility, man. We're coming into the summer. We got rising crude prices. We have inflation still raging, and that's the next chart in this article, okay? Services inflation still rising. Now, this is dated today, okay? We just got the numbers last week, but you get into where we are. Personal consumption expenditure deflator shows continuing price pressure. You have goods in blue. Yeah, we're dropping, man, okay? But, folks, you look at services, we're going up, man, okay? We are going up 5.7%. You exclude food and energy, and yes, you do have a small dip. But, folks, take the blue out of that chart. I wish they had an option, right? You can check each box and pull a line off of it or not. Let me zoom it in a bit. If you take the blue off that chart and you just showed a chart of services and you showed excluding food and energy, you saw those two, okay? You're just looking at black and gray in there. And then you juxtapose that to the implied futures for the federal funds implied rate. What would your brain say? Your brain say, that doesn't make sense, man. Your brain would say, hold on a second. How is the market pricing in that we're going to be cutting 3 times in the next 9 months? Meanwhile, we have the services sector, and then you have excluding food and energy, flirting with 5%, barely ticking down. And we've seen slight ticks down before, okay? So, yeah. And then you get into, okay, using statistical measure beloved by the Fed, the trimmed mean, okay? This involves removing the biggest outliers in either direction and taking the average of the rest. So you're trimming the edges, and then you're taking the mean, as they would say. Also confirms a picture of inflation that has slowed down very slightly, but is still too far above target to justify a change in policy. That's calculated by the Dallas Fed on both a monthly and a yearly basis. Okay, now you got the trimmed mean month over month in blue. You have the year in black. And yeah, we have a slight dip, but do we have a slight dip that's going to cause us to cut 3 times in 9 months? I don't know, folks. That's my take on things. Pretty clear as day. We'll talk a couple other equities when we get back. We'll talk a little Walmart as well. Stay tuned, folks. One more segment. Don't go away.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We talk a little bit of Walmart. Walmart aims for more curation, less clutter, in a new online look. I took a look at them real briefly this morning, but I will tell you my personal opinion is I've been to Walmart, and I've experienced probably the demise of what they're talking about in terms of you pull up Walmart, you search something, folks, and somehow they combined where basically you were searching like Walmart's items, but then also was on there was third-party sellers. So it was this really weird environment where I would just want, listen, show me the products that Walmart's offering so I can have some confidence that I know that I'm getting a pretty good deal, because if Walmart's offering it, it's usually a pretty good deal. And if you ever go online, there'd be items that are just priced at astronomical levels on Walmart.com, and somehow it's just a third-party seller in there trying to sell you something at some inordinate markup. Nonetheless, it's a new revamp of the website and the app unveiled today, seeks to highlight a selection of goods and cut down on the clutter. The goal is to entice shoppers with items they weren't necessarily looking for, instead of offering a utilitarian framework for consumers who already know what they want. Nonetheless, the battle continues as they're trying to keep up with Amazon. It'd be interesting to see how that plays out. All right, and we'll finish it up with ChatGPT. So again, an opinion piece here, but it's talking about, quote unquote, the iPhone moment. Poses a new threat to Google, and it's a new plugin. So just as we're getting used to the idea of ChatGPT, and folks, it's amazing. If you haven't tried it yet, please go sign up and try it. It's remarkable, and it allows you to just kind of A quick glimpse of how things may change that quickly, but they got new plugins released last week, relatively little fanfare, but they're a major leap forward is how they put it here. In a nutshell, what they're doing is they allow businesses to plug the tool into their own systems, and they can do things like search proprietary databases, etc. The world is changing pretty quickly, man, and Google better catch up. Now, they have Bard, okay? They are going to be trying to catch up. But, yeah, that's an interesting one to say the least. And we jump over to Microsoft shares. They're down 0.3%. NASDAQ 100's negative today. You got Google shares. Let's see how we're doing. Catch up for me. Come on. A little bit slow this morning, even though my internet seems to be doing all right. Google down about 0.3. We'll finish it up with Apple shares, the big dog. Can't hold Apple down. Up 0.3%. As I said, folks, keep your eye as this market climbs 41.46 up towards the recent highs of this year. You're talking about 42.08. Stay tuned, folks. We got our man Basil Chapman coming up next, live programming. Thanks for starting your Monday off with me. Look forward to talking to you tomorrow. Stay tuned for Basil, folks. Have a great one.